Joining us is Wells Fargo Investment Institute Senior Global Market Strategist Samir Samana and iCapital Chief Investment Strategist Anastasia Amoroso. Guys, welcome. Anastasia, so on the S&P, can we show a 6-month chart? Because we're back near, I think, the Friday lows before that big rally. I mean, just the last trading day. Also happens to be near the 2025 lows from mid-January before a solid earnings season kicked off with the banks. And also right about near the pre-election highs. So my question is, with that in mind, it's not like these levels are brand new. What determines the trajectory from here?
Right. Well, John, I think if there's one silver lining about the current setup is that a lot is starting to be priced in. You know, clearly tariffs is a very disruptive thing to most everybody in the markets in various countries, but there's a point to where it becomes priced in. And when we talked about the Mexico tariffs and Canada tariffs and China tariffs first back a month ago, the calculation was that it's somewhere about a 5% downside that has to be priced into the market. Maybe it's because of market shrinkage, margin shrinkage that has to take place, and also valuation shrinkage as well. But guess what? We are down 5% from those 52-week highs, and we do have, it seems like, certainty of those tariffs going into effect. So with that, the valuations, the levels have been reset. And if you look at the investor sentiment, it is as bearish as we've actually seen it going back to 2022. If we look at the relative strength indicators, I think we're probably going to get hit oversold on a lot of those various stocks. So I do think this is a better setup now. And the bar for upside surprise of any sort is now a lot lower. That sounds like a silver lining. With Samir, at the same time, there are growth concerns now that maybe there weren't before. I know you say we believe deregulation and tax cut extensions will help the economy more than targeted tariffs, and immigration restrictions will hurt. That's what you guys are saying at Wells Fargo. But will they help as quickly as they might hurt?
Yeah, that's the key, John, is unfortunately from a sequencing standpoint, and we've said this for a while, the market just has not woken up to the fact that, you know, the Trump administration was going to tackle some of the market negative stuff first, which would include, immigration, and was going to include tariffs. And you just saw this game of chicken. And to be fair, President Trump probably played a role in it by reversing the tariffs as quickly as he did on Colombia, and then kicking the can down the road on the ones for Canada and Mexico. So he kind of played a part with respect to the markets maybe not taking him seriously. But now that we are here and the tariffs are going into effect, I think it's going to last a little while. And look, the market's got a little bit more positive seasonality into, April, but then you kind of hit the summer seasonals, which aren't as great. So I think, you could have a few more months of just sideways chop.
Anastasia, I want to get into the silver lining a little bit more, because what we have seen is a very defensive tone in the market. We've seen Treasury yields come off pretty dramatically here in the last, call it week and a half. You've seen real estate, consumer staples, healthcare, utilities, the more defensive sectors in the S&P outperforming. They actually finished in the green today. Are these, and equal weighted S&P did better than cap weighted. So we've been talking about the rotation even before we've gotten to this moment with tariffs and growth scare. Are these the places that you invest right now, or is this a head fake?
No, I think there are places to hide, and some of them which you mentioned. And by the way, completely agree with Samir that, the sequence is everything, and tariff threats were going to come before tax cuts. The most likely scenarios, the bars I mentioned is set lower. So maybe it's the Fed this month. Maybe it's the payrolls report this month. Maybe that's what kind of provides the markets with some stability. But I do agree that tariff threats are not about to go away. And in fact, they may be with us for quite some time, meaning the cyclical parts of the economy may be suffering for quite some time. And I say that because, Morgan, if we looked at the last instance that we had tariffs, and if you look at the manufacturing surveys, they were in this declining trend for about a year. I'm not saying we're going to get that, but let's say it's 3 or 6 months. In that case, even if we get a temporary pop in the market, I probably wouldn't step in and buy some of those cyclical sectors because of that precedent that we had before. However, what I would buy is I would look to the domestically oriented parts of the market, not only from the perspective of revenues, but also from the perspective of your cost of goods sold. What you don't want to be doing right now is importing your input costs from Mexico, Canada, China, and a whole lot of other places. So financials, real estate, healthcare, utilities, those are the sectors that stand out to us, even though they have held up better and arguably they're a little bit more expensive than beaten up tech.